Hey traders, this is Blake Morrow with Trader Summit, and I have a special guest for the very first time. We're just going to call him Deer from Deer Point Macro is with us today. How you doing today?
I'm doing well, Blake. How are you doing?
I'm doing great. Now, this is a interesting interview because it's our first time that we get to meet. But you're going to do this interview anonymously, known as Deer, and I want you to explain to the traders that are listening in what you do and kind of why we have to go about this process.
Yes, so certainly. So I'm working in Canada, and I'm working for a global asset management company. So obviously there is some flexibility, but obviously the anonymity is more so that the fact that nothing can be kind of related back to the employer, and none of these views are kind of the view of the employer. They're obviously my views entirely. So that's kind of why the anonymity. And when I was before I went to this place, this job that I'm working at is relatively new. I was at another bank in Canada, so kind of the same thing, just regulatory oversight.
That makes a lot of sense to me. I understand that completely. Well, let's talk about what your special what what you're in tuned in right now from a global perspective. I know your focus is predominantly on currencies, but what are you seeing right now that really jumps out at you, especially now that you got all these central banks that are. It seems like that we're near an inflection point for higher rates. What are your thoughts here?
Yeah, that's actually what has kind of piqued my interest the most, is kind of what we are seeing with interest rates and kind of what the market has pricing in. Now, if you kind of look at the forward curve, the pricing of interest rates, it seems like the market's pricing in, the fact that the Fed's done. Obviously, things can change. In the beginning of the year, it was saying we would have had cuts by now. So obviously the curve gets repriced, but that's what we're seeing. What's interesting though is if you look at market pricing of where it thinks the BOE is going to go or the ECB, they are pricing in kind of further hawkishness from the ECB and the BOE in particular, just due to the fact of sticky inflation and things going on there. So, these changes in differentials, I think, are going to be very interesting. And then, as you mentioned, how that actually flows through into what we see in currency markets. And we, got some news from Brazil, and it looks like Mexico's kind of as well ending the
Rate hike
interest rate hikes.
campaigns, right?
Yeah,
Yeah.
rate hike campaigns. And obviously, for people who watch Forex markets, the peso has been extremely strong relative to the dollar. So it'll be interesting now that that's starting to unwind, if we get a little bit of a reversal and start to see some more dollar strength against some of these emerging market currencies.
Absolutely, and that's been like you talk about the Mexican peso. That has been the darling. I just referred to it as that just a few days ago. The darling of the FX market. The carry interest has been great, and as you were pointing out, a lot of LATAM, Chilean central bank, they're kind of reversing course here. And do you think this is going to be they are going to be on a rate cutting campaign? Do you think that's going to be fairly common with a lot of LATAM markets and currencies and central banks?
I I think it's going to be the ones that are extremely tied to, let's say, China's growth, right? So like places like Brazil, places like Chile, places like Argentina that have kind of relied, or the Chinese have relied on for from a commodity standpoint. And obviously now, China's doing a lot of infrastructure build out in Mexico as well. So I think that those that are very, highly linked to the growth of the Chinese economy, we'll probably start to see maybe some slowing. And I think that this is why we're starting to see them start to anticipate rate cuts, especially with what we're seeing now out of Chinese PMIs contracting. Chinese growth quarter over quarter, I think, was like 80 basis points. So there's a lot of weakening coming from there, and I think that that's going to flow through to a lot of these Latin countries going forward. So that should be something interesting to watch.
Absolutely. Well, Dear, I know you brought a few charts for us to see. Do you want to go ahead and dive into those?
Yeah, I'll go ahead and dive into those here.
Sure.
So I will go ahead and share the screen, and yep, the screen should be good. And so I'll just start from the beginning.
Sounds good.
So something that obviously is just kind of top of mind here. I know we're not talking on banking, but now that we got that Fitch downgrade lately. It does seem to kind of have flowed through into even U.S. markets. So the CDS for American bank risk is actually starting to rise slightly. It's at about 75 basis points or so. And we are seeing that even though there's a lot of talk about Europe in a recession, it doesn't seem like there's a lot of banking risk being priced in. Obviously, we see March when things were going on with Credit Suisse, but since then things have kind of started to moderate. So that's just something to kind of keep in mind. That it doesn't seem like the market really is anticipating much risk going forward. And this is just something kind of on global growth. It's looking at the deficit as a percentage of GDP versus world GDP. This is on an annual basis. So this ended in 2022. What's interesting about that, though, is, some people have talked about the US deficit being too large. One thing that we'll kind of get into, within this is kind of this idea of the US's job of supplying, the world with dollars, and one way we do that is by running a deficit. And right now, it actually looks like the deficit might be not large enough to sustain further kind of economic growth going forward. So that's just something to keep in mind as well. This is now getting kind of more into the FX market. So on the first chart, which it's labeled on the kind of the top there, what we have is the purple line is the European US differential. And so what we're seeing now is that differential is starting to tighten, and now we're starting to see, a rollback in where we were with the US dollar. So the euro starting to weaken as that differential starting to widen in favor of the U.S. relative to the euro.
Can I
Going on to the yeah.
can I ask you a question right here? And as you say that the interest rate differentials may start to tighten. Do you also look at positioning too? I mean, the market's been pretty, speculatively pretty long euros as of late. Is that factor into your analysis at all?
Yeah, that is something that I look at, and I'm thinking that that's going to probably end up unwinding. What we did see was, a lot of people had started to move into the euro as things started to normalize, especially hedging costs. Before, hedging costs was like, minus 300 basis points. So, now that all of that started to kind of become more attractive, I do think that it pushed a lot of investors into the euro. But obviously there's a lot of things that move FX markets. But one that I do like to focus on a lot is just differentials, because it's like, where if you're a portfolio manager, where can you get the best yield, right? And then if we start to talk about real yields, the US is still, I think, one of the more attractive areas, at least in terms of, where are you going to get the highest real yield? And when I say real yield, we're talking, a treasury of X tenor. So let's say, 5 years versus a 5-year break even, not against the CPI. So I always compare it to where the break even's trading.
Okay. So very good. Very good. Sorry, didn't mean to interrupt you. Just wanted to
No,
ask that
no,
question. Okay.
no, you're fine. You're fine. And then moving on to the next chart, we have the pound. The pound interest rate markets were actually pricing in the BOE to out-hawk the Fed. I think that now that's starting to turn around, as we can see. So the red line here is the differential between the pound and the US dollar. Right now, the pound is about 19 basis points higher than where rates markets are pricing the US dollar. But again, that's starting to come down, and I do think that that's going to drag down the pound. And the darling over the last 2 weeks has been the yen, with everything coming out of the BOJ. And right now, what we're seeing in the differential markets is higher pricing as well for the US dollar relative to the yen. And obviously, the yen's been weakening. It's now trading at 142. This graph, as you can see up in the top right, is actually as of this morning. So I took that all of this is as of today.
Right.
Moving into cross-currency basis swaps, which, to be kind of, I won't get too technical about it, but just think of it as, a way to price, dollar shortages. So the more negative it is, the more costly it is to essentially get access to dollars in very simplistic terms. So we have the yen down here in blue, and obviously the pricing are the tickers for those are all up in the top here. Then we have the franc. Then we have the euro and the pound. So what we're actually seeing is that, access to dollar liquidity is easing. We're not really seeing massive shortages in the need for dollars right now. But some of them are still relatively low. Like one that stands out is the franc. The franc is relatively low in the sense that it's wide relative to where it's usually pricing for dollars. So that's just something else to keep in mind.
So
Um,
when you're looking at this chart, dear, if you start to see all of those charts turn higher, is that a warning for you?
it's not as much of a warning. So, for example, like because we have the euro dollar banking sector or the shadow banking sector, global capital markets have become intertwined. So, if we look at the green line here, which is
Yeah,
the pound is usually actually above the zero, which means, like in theory, let's just say they have an excess of dollars. And the BIS releases some data on this as well through their locational banking statistics. And the UK banks are actually a net lender of dollars in capital markets, so they usually have a surplus of dollar liquidity. The euro, the Japanese, and the Swiss are usually borrowers. The other one that's usually a lender as well is the Aussies. So if it was to go, higher, it's just saying that they actually have a surplus relative to, you know, where rates markets would normally be pricing. So the
got
the
it.
more negative it is, the more expensive it is to essentially um, be lent dollars. You have to pay a wider basis. So like for example, the Japanese right now, they would have to pay 47 basis points. Um, so that's kind of how it's priced.
Got
So
it.
the
Okay.
the wider it goes, the more worried I would be.
Okay.
Because that means for example, like COVID, when you had freezing of, interbank liquidity, and money market funds were seeing outflows, we can see, massive kind of drawdowns here where you started having heavy pricing because counterparty risk, etc.
That makes sense.
Um,
Okay. Thank you.
Not a problem. And then this is just something that I've been watching this for about over a year. This is the 10-year interest rate swap. So pretty much what the cash markets, saying they don't buy this, 50 basis point cap. And, obviously the Bank of Japan came out and said that they were going to ease this. So now, the cap is now 100 basis points. Will they'll buy overnight? And they've kind of allowed it more flexibility. So right now, the 10-year JGB is trading at 64 basis points, but cash markets are saying this needs to go a lot higher. And then obviously the gray line here is the spread between those. And historically, that spread has been really tight and it's just absolutely blown out where cash markets are saying, hey, we don't believe that this cap's going to hold. The BOJ is going to have to capitulate and they're going to have to move that cap higher. So that's just something to watch as well.
So if they move the cap higher, would that equate to a much higher US dollar Japanese yen exchange rate then, correct?
Yes,
Okay,
yes,
great.
exactly.
Thank you.
Not a problem. And this is just borrowing needs for the Japanese. So this is looking at kind of what we were talking about, bank lending. This is essentially looking at dollar-denominated assets relative to dollar-denominated liabilities. So obviously, Japan has less denominated assets relative to liabilities. And this has kind of pushed this cross-currency basis swap further down. So, the way that they're kind of filling that is by going to these derivative markets and accessing dollars there. So that's as well something that kind of continues. Moving on to something that's been very popular on Twitter, it's been this whole idea of BRICS. And this is looking at, again, something very similar, but within global, like the macro economy. China's or the BRICS, sorry, their dollar liabilities versus their dollar assets. And this is actually showing that they're net long dollars, and this hasn't really changed a whole lot. So this includes all the, BRICS nations, Brazil, Russia, India, China, and South Africa, and kind of their positioning in FX markets, and that can be found on the BIS. For anybody who wants to take a look at it. So this is kind of saying, no, these people aren't de-dollarizing. And this is actually on a quarter-over-quarter basis. So it is about 2 quarters late. They haven't published Q1 of 2023 yet, but as we can see, I mean, this line really isn't moving. It seems like BRICS nations continue to kind of clamor towards dollars.
Yeah, I mean, and so that the whole de-dollarization story, you're basically calling BS on it a little bit.
I'm calling BS on it, and this is something that I think people have gotten really overblown is how much these nations are reliant on dollars. And
Yeah.
even now here we're looking at Saudi Arabia. This is their banks, their net dollar positioning, much like Japan. They have a shortage of dollars, and that has pushed their basis negative. So even we're seeing nations like Saudi Arabia, and this whole idea of the petrodollar. They still don't have enough dollars to continue funding relative to what they have for their liabilities. And we see this for everyone. It's the same for the Indian banks as well. And it's the same actually for Argentina. And Argentina, the funniest thing about this is, for people who've probably been plugged into the news, they used yuan to pay off their debt, but then the IMF came in and gave them, a $7.5 billion aid deal. So again, even Argentina is utilizing yuan, but then in their new funding package, it's being funded entirely in dollars. So this is just something that is interesting to kind of keep an eye on. But all three of those charts are pretty much very related, just in this idea that these nations that are supposed to be de-dollarizing
Yeah.
actually have massive shortages of dollars relative to their liabilities outstanding. And this moves us on to the mother of the kind of the head of BRICS, right? Is China. And so I'm looking at China's macro leverage here, which is, aggregate credit being utilized to kind of, grow GDP. And we see that these two things have kind of moved in tandem, and they've become kind of more entwined, I would say, since, kind of the early 2010s. And so if China can't get, grow leverage, they're going to have a very hard time growing GDP. And we've seen that China's continuously easing. But if we look at their growth numbers, it doesn't look like they are really being able to juice demand. And, China already has a very big savings base at the consumer level. And so, as what Keynes talked about is the, marginal propensity to consume and save. China really, the average citizen doesn't have a large, propensity to consume out of every dollar of disposable income. They would rather save that. And even with China trying to ease policy, people just aren't taking credit, and we can see that this is starting to obviously pull down their growth.
So dear, it's funny. You know that old saying, you can take somebody out of the trailer park, but you can't, or take the trash out of the trailer park, but you can't take the trailer park out of the trash, or something like that. Whatever that saying is, it's a silly saying. You'd probably know it better than me. Not for any, just because I'm bad at like sayings, just in general. But if you're talking about China, I mean, here's China drastically over the last, several decades trying to shift their economy to a consumer-driven economy. And really what you're saying right now is it's very, very difficult for China to reshape, the Chinese consumer, and they're having a very difficult time in doing it.
Yeah, exactly. And I think that this is actually going to bring down their growth. And, I'll Lacey Hunt talks about this a lot. And, Irving Fisher is somebody who I had a lot of respect for. He was an early economist in the US. But it's just this idea that, China is actually more indebted than the United States. So when guys like Ray Dalio, et cetera, talk about the US's debt situation, China's in a much worse position. Last time I looked at it, I was looking at, how much increase in debt do they need to, increase $1 of GDP, and it was about $2.20 of debt in China to generate $1 of GDP, whereas in the US it's 140. So their utilization of debt, what we're seeing essentially through that, how large that figure is that the debt that is being used is not producing sufficient cash flow to be able to actually contribute to the repayment of that debt. So it's just this vicious cycle of digging, the hole deeper and deeper and deeper.
No, okay, all right.
And this is even what's even more interesting when we look at BRICS. So, China equities, these are equity inflows into China,
Yeah.
are relatively high. But I personally think that that's, a function. Oh, went all the way back. I think that that's a function of the fact that, China, a lot of emerging market ETFs, et cetera, kind of this idea of passive flows you're going to have to continue to allocate to China because 40% of emerging market ETFs are Chinese weighted. But if we start to look at debt, this is the first time for almost a year, and this chart ended as of March 2023, but this is the first time we've had a year of debt outflows. So that essentially means that people who are holding Chinese debt are getting rid of it. So, if China was going to replace the United States, you would want to see people holding their debt and having faith in the government. But, a lot of these emerging markets that do hold this debt, because that's where most of it's denominated in places like Africa and some of the stands, and some of the Middle East, these people no longer want to hold Chinese debt. They don't have any faith, it looks like, in that, in the ability of repayment. So
Wow.
we're seeing those people liquidate that debt. Um, and this is just looking at FX reserves. So this is aggregate capital outflows. So we're seeing China has now negative capital outflows versus their FX reserves. And China has capital controls. So what we're seeing is if these outflows are happening, but we're having no net effect on FX reserves, then this must be taking place offshore. And we can kind of see how capital outflows now are kind of following what is happening in cross-border, the kind of the offshore dollar yuan market. So people are just converting currency offshore because of China's regulatory environment and framework. They can't do that onshore, and that's why we're not seeing any net effect on China's FX reserves.
Now that data is not from 23, it's from 22. Is
Yeah,
that correct?
yeah. So this one is this one's on a quarterly basis. So this one's 1 quarter lagged, and this one's also lagged by a quarter because this is from the BIS. So yeah, both of these are from the end of 2022.
But I think people can get the gist of it, and the point that you're trying to make here, that the fact that the dollar is getting de-dollarized is more. It seems more of a facade than anything, and maybe more talk.
Ex- Exactly, exactly. And this is also interesting. This is as of today. By the way, this is from Refinitiv, but this is Chinese corporate CDS. And so what we're seeing is CDS is starting to ease, but usually we have the Chinese PMIs here. They're inverted, but usually when we have a contraction in PMIs, that sends CDS up. So when people think of what kind of happened in China with defaults, it looks like these defaults are pretty rapid and going forward. So we're now seeing that contraction in the PMIs. We should start to see this CDS start to increase as well. So again, just showing that the state of the Chinese economy is relatively weak, and that it's not this large growth animal that's going to overtake the United States. And same with Saudi Arabia, right? This is one that people have also been talking about. This idea that the East is now going to kind of overtake the West. Saudi Arabia is seeing their capital flows come down drastically. And with that, we're seeing this increase in the CDS. And most of that capital flow that we did see, this massive increase, came from when oil was strong. But now that, oil's been in this range between 70 and 80, I think that, they're going to continue to have, outflows. And this was as of, 2 months ago. This was from the 6th of 2023. So That's the
Gotcha.
key.
Well, I know your time is very limited, and you've got to get hopping. Is there any last minute messaging you want to give to the Trader Summit community regarding your thoughts here?
Just the thoughts is definitely watch differentials. FX moves are going to continue to be extremely attractive, and don't kind of get, don't go long China because you think it's going to overtake the United States, or long, the Saudi Rial. But I think the differentials and, FX markets have actually front run bond markets and telling us what markets anticipating going forward through the rest of the year.
Awesome. Well, dear, thank you so much for your time. What's the best way that traders can follow your work? Because I just recently started following you too.
Yeah, so it would be the Deer Point Macro on Twitter, and then as well from there I have the Substack, and those are kind of the two places that I'm on the most.
You vent too.
Yeah, that I've been to, exactly.
Well, I want to say I appreciate your time, and I look forward to actually being able to sit down and having a little bit more time with you the next time that we get a chance to meet. So thank you so much for spending your time here. And if you guys and gals like what Deer had to say, make sure you give him a big thumbs up and subscribe to the channel for this exclusive content. So thank you, Deer.
Thank you, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.